Historically, there's three goals, and gold achieves that. They want stability, they want liquidity, they want returns. But what we've seen over the past 4 years is that there are additional reasons to want to buy gold. In addition to diversification, it's concerns around geopolitical risks, it's wanting to have a store of value, it's wanting to have that hedge. And it's not just central banks. We're seeing that play out through the investor side as well. But for central banks in particular, they've been the marginal buyer.
Is it a return to the 1930s, the 1920s, the 1910s?
It's not so much a return to wanting to have that monetary stability. It's more so wanting to strengthen balance sheets and have optionality, but also wanting to diversify at the same time. So some of it, there's a central bank gold survey that was released last week. And this is, I'd say, the best survey for us to be looking at because it signals from 76 different central banks what their intentions are. And we had a record 45% saying that they intended to increase their own gold reserves over the next 12 months. And that's the highest we've had. And when we had such strong figures in the past, it's translated into record value terms in additions.
Since the end of January of this year, gold's down about 25%, and we're below $4,000 per ounce. What's going on there?
It's a historic day in that we've seen the lowest settlement since November 2025. We've seen a huge pivot from January to now to what the gold market's focus on. Yes, there was overpositioning at the start of the year, but there was also more of a focus on the structural drivers behind gold. Now there's been that pivot towards less so the debasement trade, concerns around real yields rising, the dollar being much stronger. So we've seen these macro headwinds developing, but it's come at a time when we've seen a need for liquidity really pressuring the gold market. So it's a combination of factors, a combination of headwinds that we think are going to keep gold price fragile in the near term. But beyond that, we're still positive.
Yeah, because I'm just looking back at my gold chart here on my Bloomberg terminal here. It's been, for several years, nothing but up. So this turn down is really something different. And I'm wondering, because it seems like when we were talking about gold over the last 4 or 5 years, it was just everybody was buying. The central banks were buying. Individuals were buying. Everybody was buying.
Yeah, that really, I think 2025 was the year where we had investors wanting to buy, ETF holders, short-term investors, and central banks. But before then, it was largely central banks that had helped to raise the floor for gold prices. But what's changed this year is that we still have that central bank buying, but the ETFs have turned negative. We've seen significant outflows.
So is that an opportunity? I mean, when Steve Englander leans over the desk and says, Suki, where are we going? Are you saying gold 6,000?
We haven't changed our price forecast. We still have 5,150 as our Q4 average.
Come on, Suki, I got to make some news here.
So, but in the near term, it's fragile. Okay. India's demand has slowed down. We've got the headwinds from real yields. We've got focus on the inflation data in an hour's time, where markets might be pricing in an increased, ever increasing probability of a rate hike.
I just finished Liaquat Ahmed's new jewel, 1873. Of course, he wrote Lords of Finance years ago. And the arc over that is how gold and silver bounce off the mining, the supply. Oh, we found silver in Nevada, therefore the silver price changes. We have record gold mining now. Am I right on that?
We do.
What does that mean for the price of gold? Is that bad?
It hasn't been, because the market's been so keen to absorb all that supply. We haven't seen recycling responding as much. Normally it's price elastic, but we haven't seen as much distress selling when it comes to
That's because Alexis hasn't sold the gold. It's still there.
So what else in the world of precious metals jumps out at you these days? Where's their value, do you think?
Relatively, we think going forward, there's going to be much more focus on where we see demand growth. And of course, there's the AI demand growth, and that benefits silver, benefits platinum. And when we're looking at chips, we're looking at electronics, hard disk drive. So that demand looks robust. We look for markets where we expect them to be undersupplied. We think the platinum market is likely to be undersupplied for the next couple of years.
Where does platinum come from?
Largely from South Africa and then Russia.
Tiffany's.
Wow. Exactly, on Fifth Avenue.
Nailed that.
Exactly. So platinum, and talk to us about palladium as well.
Oh, listen to you.
I got my global commodities price thing up on the Bloomberg terminal. I'm quoting everything.
Palladium is under a little bit of pressure right now with the Middle East conflict, reinvigorating concerns that we might see a faster pace for EV sales, and that's put the internal combustion engine sales perception under pressure, at least in the near term.